Good morning, everyone. You're welcome to 321 revision class on advanced taxation. I know you must have read all the topics as you have watched from the video. So this is just a revision. And of course, my name is Chidebere. So as we go on, if you have any question like we do not hesitate to ask. Okay? So we want as many questions as possible as we go on, especially those gray areas. So this is another opportunity for you to clarify them. So like I said, this revision is on advanced tax. And of course, some of the topics we have discussed, the key ones, we have basis period, we have capital allowance, so for commencement, how do we get those three things? All right, so under basis period, all right, welcome to 321 revision class on advanced taxation. Okay, I know by now you must have read all these topics, so there may be some gray areas you need clarifications on, so do not hesitate to ask questions on them. My name is Chidebere. So we start. These are the topics, the key topics you expected to know for your exams. These are the key among others. Okay, so we are going to try as much as possible to revise them one after the other. So as we go on, if you have questions, please send in your questions. All right, so we start with the first one, that's basis period. Now, under basis period, what are we looking at? We are trying to look at how to assess a business as commenced operation, a business as ceased operation, change its accounting date, and ongoing business to tax. Okay, so in other words, how do we get those three things? Tax years, basis period, and assessable profit for these 3 or 4 categories of businesses. So the first one we'll quickly revise is commencement of trade. So if a business commenced operation, how do we determine the tax year, the basis period, the assessable profit, especially for the first 3 years of commencement? Now we said to do so, we have the old rule. And now with the Finance Act, we have the new rule. So for the old rule, how do we get the tax years, the basis period, the assessable profit for the first 3 years? So for the old rule, we have 2 computations that will be done. If you remember, we have what is known as a normal or original assessment. And we also have what is known as the revised or optional assessments. Okay, so you normally do 2 computations so that right of election will be exercised using the old rule. So the old rule means the rule before the Finance Act. Okay, now how do we get the tax year, basis period, assessable profit under the normal for the old and also under revised? So under the normal, we say for the first year, for the first tax year, that the profit that shall be taxed is the profit from date of commencement to 31 December of the year of commencement. Date of commencement to December. That's the profit that will be taxed in the normal assessment of the old rule. Then in the second year, in the second tax year, we tax the profits of 12 months. We tax the profit of 12 months from the date the business commenced. From date of commencement. Profit of 12 months from date of commencement. Okay? Then in the third year, what profit will be taxed? Basis. And of course, you know when you are doing precision tax for the first 3 years of advice. In the first year, the same thing. The first year will be the same as the first year of the normal. The first year of the revised will be the same as the first year of normal. That means we also tax profits from date of commencement to 31st December of the year of commencement. But where you have the difference between the revised and normal is in the second and third tax year. So for the second tax year of the revised is normally on actual year basis. Of course, you know what actual year basis means. That the income of 2020 will be taxed in 2020. Income of 2021 will be taxed in 2020. So the tax year will be the same with the end of the basis period. Okay, that's actual. So for the second tax year of the revised, it will be on actual year basis. The same with the third year. The third year will also be on actual year basis. So where you have the difference between the normal assessment and the revised assessment under the old rule is in the second and third year, because the first year is the same. So this is the commencement rule for under old. Okay. Now for new rule, that means the Finance Act. For new rule, which profit are we going to tax? In the first year, we tax profits from date of commencement to end of the first accounting year. Of the business. So why the old rule is saying profit from date of commencement to December, the new one is saying profit of date of commencement to end of the first accounting year. So that's the difference, number one. Remember, the essence of the new rule is so that there will be no incidence of double tax, to remove overlapping, coincidence, and gaps in between periods. That's the essence. So for the second year of the new rule, we tax the profits from the next day after the end of the first accounting period. So the next day after the end of the first one. Profit from the next day after the end of the first accounting period to the end of the second accounting period, so that there will be continuity. Remember all this. Then for the third year also will be like the second year. So it will also start the next day. So profits from the next day after end of the second accounting period to end of the third. So it follows suit like that. So under the new rule, you see that it's only one computation you are doing. You're not doing two computations. It's only under the old rule, you do normal and revised, so that right of election will be exercised. Right of election is the right to choose between the two. All right? So now, when do we use the old rule? When do we use the new rule? Now, if the date of commencement date before 2019, commencement date after 2019, okay, from 2019 rather. So what determines whether you use the old or new rule is the date of commencement. So if a business commenced before 2019, then you are using the old rule. I hope you remember that. If the business commenced from 2019, you use the new rule. That's what is expected of you. Are we together? So it means that if we have question of this nature, XYZ Limited commenced business on 1st May 2017. Keeping its records to 30th September every year. Now, which rule are you going to use? This is a commencement question, for instance. Which rule are you expected to use? You check the date of commencement. Of course, you can see the business commenced in 2017. 2017 is before 2019. So the rule to be used in this regard is what? The old rule. And if it is the old rule, what are we going to do? You are supposed to do 2 computations and choose one. Are we together? So you do your normal and revised. Of course, you are getting those 3 things: tax years, basis period, assessable profits. Tax years, basis period, assessable profits. Okay, so let's apply the rule now, the old rule. For the first year, which profit will be taxed? We say profit from the date the business commenced to December. The date of commencement in this regard is 1st of May 2017. So from 1st of May 17 to 31st December of that same year, 17. And what will be the tax year? The tax year will also be 2017, the year the business commenced. Are we together? That is the first year. Now the second and third year, once you have gotten the first tax year for the old rule, the second and third year will follow suits. Will be the subsequent years. 2017 is the first year, so the remaining 2 years will be 18 and 19. They will follow in that accord. Are we together? Now, in the second year of the normal, which profit will be taxed? We say we tax the profit of 12 months from the date of commencement. So if the business commenced 1st of May, so from the date of commencement, 1st of May 2017, 12 months, count 12 months to this. 12 months from this date will be when? Will be April, 30th April of the next year, 2018. So it will be profit of 12 months, but it must begin from the date of commencement. From the date of commencement to 12 months. So if the date of commencement is May 17, then 12 months will end April 18. Are we together? Now, in the third year, what profit will be taxed? We tax the profit of 12 months on preceding year basis. On preceding year basis. And remember, I told you about preceding year. You make use of the year end of the business. So if I'm to do PYB, I will go and find out what is the year end of the business. The year end is 30th September every year. So they keep their record up to September. That means their record keeping runs October to September. So you follow, the preceding year basis will follow suit in that accord. So since their year end is September, then it will run October to September. Okay? If the tax year is 2019, then since it's preceding year, the basis period will end 2018. So that the income of 2018 will be taxed in 2019. That's preceding year basis. So where will it begin to be 12 months? Then obviously it must begin what? 2017. So this is how you apply this old rule under the normal. Are we together? This is the application. So if we have done that, let's also go and do the revise. For the revise, we say the first year for the revise will be the same with the normal. So that means the tax years will be the same, 17, 18, 19. The first year, which is from the date of commencement to December, will also be the same. But the second and third year is where you have the difference, which I told you will be on what? Actual year basis. Actual year basis will run January to December, and the tax year will be the same with the end of the basis period. Remember, once it's actual year, you put January to December. Okay? Then the tax year will be the same thing with the basis period. That's what it's actual. So income of 2018 will be taxed in 2018. Income of 2019 will be taxed in 2019. Okay, so this is how you apply. When you are done with that, you get your figures. So let's assume we have 40, 30, 50. Of course, you know how to pick your figures here, giving us a total of 120. And here we have 60. Okay, it should be the same. The first day will be the same. 40, 60, 15. So we have 115. Now, you have to compare the two results and exercise the right of election. So obviously, the right of election belongs to who? The taxpayer. And every taxpayer will choose the lower, the one that will reduce his tax payments, of course. So this taxpayer will choose 115. So having choose 115 means this taxpayer is saying, I want to be assessed based on revised, not based on normal. So what that means is that your application going forward, in case it's a full question, you are not going to make use of normal. You concentrate on revised. That means in 2017, this is the profit that will be taxed. In 2018, 60 will be taxed. In 2019, 15 will be taxed. Okay, so anyone you have chosen, that is what you continue with in your computation. So I think we have been able to review basis period. Of course, so I expect your questions on basis period. I think this is how far we can go on basis period, so that we can also touch other topics. So you have known when to use the old rule. It's just a reminder. You know it already. You have been reminded when to use the old rule and when to use the new rule. So this is just it. Now, away from basis period, since there is no question, we can move to capital allowance. Also, let's remind ourselves capital allowance. Okay, capital allowance. All right, you know capital allowance is a relief granted in lieu of depreciation because depreciation is not allowed in tax. And you know the reason why it is based on estimate. It's estimated. You know how depreciation is computed. Everything about depreciation is estimated. So because of that, in tax, depreciation is not allowed. Okay? So in lieu of depreciation, the tax authority prefer to grant what? Capital allowance. Okay? Now, you also know the conditions for the claim of capital allowance, that the taxpayer must have incurred what is known as qualifying capital expenditure. So it must have bought assets. The taxpayer must have incurred cost on QC, and there are other conditions that must be met. Of course, then you also know the types. We have types of capital allowance. Of course, we have the initial, which is the IA. We have also the AA, annual allowance, AA. Others are investment allowance. We also have rural investment. We also have what is known as balancing allowance. Okay, so all these are types of capital allowance. Of course, you know how to compute them. Okay, you know that initial allowance is claimable once throughout the tax life of an asset. You just claim it once. And you don't prorate initial allowance. Are we together? And it's claimable on all assets. All assets. Okay, and how do you calculate it? How do you calculate initial allowance? We just say the rate, the initial allowance rate times the cost of the assets. That's how you get the initial allowance. Now, what of annual allowance? Annual allowance is a type of capital allowance that is claimable annually. And it's claimable on what? On straight line. It's claimable annually on straight line. So you must understand this. It's a type of capital allowance claimable annually. That means if the tax life of an asset is 10 years, then the company has to claim annual allowance 10 times. So you claim it annually all through the tax life of an asset, or you claim it on straight line basis. Straight line in the sense, just like you have straight line of depreciation. It means that what you claimed in the first year, the annual allowance for the first year, will be the same second, third, and all through the tax life. That's one by straight line. Okay? The only way you have difference is if there is proration. Of course, you know, annual allowance must be prorated in line with the basis period for assessment, if it's a commencement question. So once it's a commencement question, like this one, you should know that in the first year, you may have shorter period, just like this. This one is from the date of commencement to December. Obviously, this period is not up to 12 months. So assuming this is a full question and we are solving for 2017, you should know that in 2017, that annual allowance should be prorated because the basis period for assessment in 2017 is not up to 12 months. Okay? This is about 8 months. So the annual allowance you are claiming here will be 8 months, not 12 months. So that's where you have difference. Are we together? If it's a commencement question and the basis period for assessment is not up to 12 months. Now, how do we calculate annual allowance? The calculation depends on whether the asset is a new asset, remember, or whether it's an old asset. So if it's a new asset, the annual allowance is cost of the asset minus initial allowance over N. Remember N? N is the tax life of the asset. Okay, so the cost of the asset, take away initial allowance, means you must have claimed initial allowance, you must have calculated initial allowance, you take it away, then divide by the tax life of the assets, N. Why for old assets, you use annual allowance is equal to use tax written down value, N minus X. So these are the two formulas for calculating annual allowance, but you must know when to use this. If it's a new asset, this is if it's an old asset. Now, what do you understand by new asset? Remember, new assets means that no allowance has been claimed on that asset before. This is the first time we want to claim capital allowance on that asset. Okay, so once you are claiming for the first time, especially initial allowance, then that is a new asset. That means no allowance has been claimed on this asset before. So new asset does not mean the asset was just acquired today. No, that's not what made it new. It's possible you acquired asset 20 years ago, but it's still new today. Meaning this is the first time you are putting it to use in business. This is the first time you are claiming capital allowance on this asset. So it's a new, irrespective of when it was acquired. So it doesn't have to do with date of acquisition. I hope it's clear. It has to do with whether you have claimed allowance before or whether this is your first time. So if this is your first time of claiming capital allowance on that asset, then it's a new asset, irrespective of when it was bought. But if this is not your first time, then it's an old asset. Meaning maybe the tax life is 10 years, you have claimed last year. This is the second year. So since it's the second year, then it's an old asset. It's no longer a new asset. Are we together? You are continuing from where you stopped. Okay? So for old assets, it will be on tax written down value. So whenever you are giving question on assets, once you see tax written down value, what the examiner is simply telling you is that it's an old asset. And remember, for old assets, you cannot compute initial allowance for old asset because it must have been claimed in the previous years. You only compute for annual allowance, and this is the formula you use. I hope it's clear. All right. Now, we have also investment allowance. This one is also claimable ones, but the difference between this and this is initial allowance and investment is that initial allowance is on all assets. You claim initial allowance on all the qualifying capital expenditure. Why annual investment allowance rather you only claim on some assets. You only claim on plants, machineries, and equipment. So not all the assets. So you can't claim investment allowance on motor vehicle, on furniture. Okay? Why you claim initial allowance on all? You only claim investment on this. And how do you calculate investment? Very simple. We just say the rate, which is 10%, times the cost. Okay? The rate times the cost. The rate is 10% for investment allowance. And now, of course, you also need to be reminded that the Finance Act deleted investment allowance, remember, and rural investment allowance. So you must also know when to apply investment allowance and when not to apply. Okay? According to the Finance Act, after August 2023, you are no longer applying investment allowance. So you have to check your question. So if your question is before August 2023, then you can apply. You can do investment allowance. But if after August 2023, you are not required to do investment allowance. Okay, so the examiner always attaches it at the end of your question paper. So always check that table at the end of your question paper to know, to be reminded of all this. Okay, so the same thing applicable to rural investments. But you know, rural investment has to do with those businesses that are situated in rural areas, where there is no electricity, water, third road, and all that. Okay, it also was deleted by the Finance Act. So the same also rule. If it is from after August 2023, no more computation. But before August 2023, you can compute. All right? So that is just what you need to know about this. Now, this balancing allowance is gotten from balancing adjustment, when you have disposed the asset you have been claiming capital allowance on. And we said in balancing adjustment, you just you compare what? Sales proceed. Remember? You take away tax written down value of the asset. So this will give you either a balancing charge or balancing allowance if it is negative. So we call this balancing adjustment. It's an adjustment that must be done whenever there is disposal of what? Assets or QCs. Those assets you have been claiming capital allowance on. Whenever you dispose them, know that you have to go and do balancing adjustment. And in doing balancing adjustment, you want to know whether there will be balancing charge or whether there will be balancing allowance. If the sales proceed is more than the tax written down value, you have a charge, balancing charge. If the sales proceed is less than the tax written down value, you have an allowance. So allowance will always be negative. Okay? Now, what is the tax implication of charge? You remember, if it's a charge, it's taxable. Okay? If it's an allowance, it's a relief. That means you have a relief. How do you claim the relief? Balancing allowance. You add to capital allowance so that you claim them together. You see, that's why balancing allowance is part of capital allowance, because it goes with capital allowance. You add it to capital allowance and claim them together. Remember all this. I expect your questions to be coming in on capital allowance. Okay? So that is how far we can go on capital allowance. So we'll quickly move to review CIT, company taxation. Okay, company taxation. Or you can say company income tax. Okay, now under, okay, that's okay.
Why is it that in past question Annual allowance is not always prorated.
It's not always
Prorated.
okay. Okay. Why is it that annual allowance is not always prorated in past question? It depends on the question. It depends on the question. Remember, I gave you, just have cleaned it now. I told you that the only time you prorate is if you have a shorter basis period, especially when it's a commencement question. And the first year, once you have basis period of assessment in the first year of commencement and it's shorter than 12 months, then you must prorate. But if it's not less than 12 months, there's no point prorating. But you know, this proration of a thing for annual allowance is only on commencement, the first year. That's where you may have it. So if all the questions you have seen so far, they didn't prorate, know that maybe there was no shorter basis period there. There are 12 months. That could be the reason. Okay? All right. Now, let's go on with company taxation. Now, also be reminded that companies are classified into three. Remember, we have the small-sized, medium-sized, and large-sized companies. So companies are classified into small, we have medium, and large. Okay, so these are the classification. So it's either the company is small, medium, or large. And this classification is based on what? The turnover, the revenue of the business. So what makes a company small, medium, or large is a turnover. If the turnover is 25 million and below, then it's a small business. So once you check the turnover of the business, it's 25 million and below, it's a small business. Annual turnover, yes. Once the turnover is above 25 million, but less than 100 million. So any turnover above 25 million but less than 100 million, then it's a medium-sized company. So once the turnover is 25 million, but it's less than 100, it's a medium-sized. Then large-sized company is turnover of, let's say, above 25 million, above 100 million rather, above 100, from 100 million, I think it's supposed to be from 100 million, yes, that's the right thing, and above. So I take it again, 25 million and below is small, above 25 million but less than 100 million medium, then from 100 million and above is large-sized company. So these are the things you check. Okay, now what is the implication of classifying them? It will apply on the tax rate. So the size of the company will determine the tax rate to use. Once the company is a small size company, of course, you know, you tax it at 0%. Okay? That's an incentive to a small company. Once the company is a medium-sized company, the tax rate you use is 20%. Once the company is a large-sized company, you tax it at 30%, which is the standard rate for CIT. Now, but you must also know that this classification is based on the Finance Act. Okay? Now, if you have a question that the date is before the commencement of this Finance Act, then it means you are not going to classify it as such. Are we together? The Finance Act takes effect from 2020 tax years. So Finance Act takes effect from this year, this tax year. 2020 tax year. So if you are solving a question and the tax year is 2020, you know, you always write a heading. XYZ Limited, computation of tax liability for instance, 2020 tax year. Once the tax year is 2020 and above, then you have to classify this. That means this classification will apply. But once you are solving XYZ Limited, computation of company income tax liability of XYZ Limited for 2019 tax year. Obviously, know that in 2019 tax year, then there was no Finance Act. So you can't go and start and be classifying the business as such, because then there was no Finance Act. So if there's any question before 2020 tax year, that was before Finance Act. So it means that don't classify, just use the standard rate, which is the 30% to do it. But if you have a question, 2020 tax year, 2021 tax year, 2022, going forward, then you must classify the business before you know the tax rate to use. I know you know all these things. This is just a kind of reminder on all that. Now, we'll also talk of returns, that companies must file returns to the tax authority. Okay? Failure to file such returns is an offense. And what are the returns to be filed? Remember, returns filing. So companies have to take to the tax authority contents of returns. Let me put it like this. What is known as self-assessment form. So there is a form on the tax FRS portal. You have to download it or you get it from their office. You fill the form. Accounts, audited financial statements. 3, you attach your schedule of capital allowance. The capital allowance you claimed. How do you arrive at that? Show us the schedule. 4, you also attach schedule of your tax computation. The tax you paid. How do you arrive at it? You want to see the computation you did. Then 5, we want to see also evidence of payment, the evidence that you have paid, the tax you computed. Of payment, rather, of tax. So these are the contents of the returns to be filed. A company must take it to the tax authority on annual basis. Remember the due date. If it's an ongoing business, 6 months after the end of the accounting year. If it's a new business, the earlier of 18 months or 6 months. Okay? Now, you must take this to the tax authority. Failure to take this to the tax authority is an offense. Okay? Remember the penalty with the Finance Act, 50,000 in the first month and 25,000 for every subsequent month. The failure continues. Now, is a small company expected to file returns? Yes. It's applicable. They must file it. So that a small company starts at 0%. In other words, that a small company is exempted from tax does not mean is exempted from filing returns. So exemption from tax is not exemption from returns filing. Are we together? So returns is also applicable to small company, is applicable to medium, and is applicable to large company. Okay, so we also have what is known as minimum tax. Remember, minimum tax is the lowest possible tax a company is allowed to pay. So on no account will you be allowed to pay tax that is less than your minimum tax. So meaning when you compute the tax to be paid, which is your normal computation, then you also have to run another computation known as minimum tax computation so that you can compare the two. So if your normal, the tax with regard to the normal is say 2 million and your minimum tax is saying 5 million, then you won't be allowed to pay less than 5 million. So minimum tax is the lowest possible tax a company is allowed to pay. And how do you compute it? Minimum tax. We say minimum tax is 0.5% of your gross turnover less franked investment income. I hope you remember this. This is how you compute minimum tax. Then what is your gross turnover? The gross turnover here is all the inflow of economic benefits, all the money that came in, all the revenue received by the business. Okay? Whether it came in by way of maybe the revenue itself, whether it came in by way of cash, whether it came in by way of receivable, whether it's rent, dividend, royalty, interest, commission, all the money that came in, sum them up. That is the gross turnover. Then what is the frank investment income? Frank investment income is dividend that have suffered withholding tax. Okay? That dividend that have suffered withholding tax. So meaning this dividend will be part of the gross turnover because it's an income to the business. So you add it to be part of the gross turnover, then you take it out as frank investment income because it has suffered withholding tax at source. And that withholding tax should be the final tax. It shouldn't be taxed again. Okay, so that is how you compute your minimum tax. Are we together? Now you know that when you are given a CIT question, when you read your question, you're supposed to take note of all this. Are we together? You should know when to do minimum tax and when not to do minimum tax. For instance, or let me also remind you that we have companies exempted from minimum tax. So there are companies that are specifically exempted from minimum tax. That means don't compute minimum tax for them. They are exempted. Are we together? So you must also note that. So when you read your question, check. If it is an agricultural company is exempted from minimum tax, don't do minimum tax. So once you read the question, they say XYZ Limited is into Agri-Allied. It's an agricultural company. The meaning of that is that don't do minimum tax. Don't compute minimum tax. It's exempted from minimum tax. Are we together? So agricultural company is exempted from minimum tax. 2, companies with turnover less than 25 million. So once the turnover of the business is less than 25 million, you know what that means? Once it's a small company, don't compute minimum tax. So small companies are exempted from minimum tax. That's what it means. So you also need to check the turnover. 3, if it's a company within the first 4 years, once the company is within the first 4 years of operation, that means the company just commenced. The company is still within the first 4 years of operation. So companies within their first 4 years of operation, they are exempted from minimum tax. That means minimum tax set in from the 5th year. If a company have operated up to 5th year, then minimum tax will set in. So you see that there are conditions. So when you see a question, before you do minimum tax, you must ask yourself these 3 questions. 1, is it an agricultural company? If it's an agricultural company, don't compute. 2, is the turnover less than 25 million? If the turnover is less than 25 million, don't compute. 3, is the company within the first 4 years of operation? So you have to check the date of commencement and check the year you are computing. Count it. Once it has exceeded 4 years, compute. But once it's still within the first 4 years, don't compute. So these are the 3 companies that are exempted from minimum tax. I hope it's clear. So now, how do we compute? Let me just give you a format. All right. Okay, let's.
I'm taking you back to capital allowance.
Okay.
If we see assets such as partitioning of office building, how do we know the QCE belongs? And then also is land in QCE.
Okay. Partitioning of office building.
Yes. How do we know the QCE belongs?
You don't compute for partitioning. Don't compute capital allowance. Now, partitioning is a capital expenditure, quite well, but it goes to capital gains tax. So you claim for partitioning whenever you dispose that asset. So partitioning, don't compute capital allowance for it. Ignore the computation. But whenever that asset is disposed, that cost of partitioning will be part of the allowable expenses for CGT purpose. So it goes with CGT. You don't compute capital allowance for partitioning. Then there's another second question. The second question.
How do we know the QCE belongs?
Okay.
And also is land the QCE?
Land is not a QCE now. Land doesn't depreciate. You know, capital allowance is in lieu of what? Depreciation. The question is, do you claim depreciation on land? There's no depreciation on land. So if there's no depreciation on land, you can't claim capital allowance on land. But in some accounts, you may have land and building as a single asset. So if you have land and building, then you assume that is building, they are together. But if you have land just as a separate asset, you cannot claim because land doesn't depreciate. So you don't compute capital allowance for land. Remember I told you partitioning, you don't compute capital allowance for partitioning, you don't compute for land. I have told you the reason. For partitioning, it goes to capital gains tax. Whenever you dispose the asset, that's when you claim the cost of partitioning as an allowable expenses for CGT purpose. Then for land, it doesn't depreciate, so you don't compute. I hope it's clear. All right. So let's see how we compute CIT. So for CIT, you read the question, you figure out the basis that will be applicable to the question. Normal basis will always be there, where you do all those adjustments. Do you still remember? Then minimum tax may be there, depending. So you have to check these three things to know whether you are computing minimum tax or not. We also have dividend basis, where you also take cognizance of dividend, excess dividend rule. Now, for the normal basis, let me just remind you briefly. Normal basis is all about adjusting the accounting profits. Any profit you see in the income statement is an accounting profit. Whether they call it net profit, whether they call it operating profit, profit before tax, all of them are accounting profits. So you need to adjust because that accounting profit is not suitable for tax purpose. So you need to adjust to get the one that is suitable. That's what you do on the normal basis. Okay? So your normal basis will start from either they call it net profit, you see the line item there, or maybe it's only operating profit you are seeing there. Let me not make the list much. Or let's say, most times you see net profit, profit before, profit after. So you always use profit before tax. Don't use it after. Then at times the business, maybe they declare loss. So maybe there is no profit. The only thing you saw there is loss for the year. So if it is loss for the year, you also start with it. So you have your loss or profit. Let's assume this. If it is loss, it will be in bracket. That's just the difference. Then there are 4 adjustments you do. Remember, you add back what? Disallowed expenses. You know those expenses that are not allowed, like depreciation, we say it's not allowed. If you see it, you add it back. Increase in share capital is not allowed. Okay? General provision for bad and doubtful debt is not allowed. You know many of them that are not allowed. So when you see them, they have been deducted from the income statement. What do? You add them back. Okay? Now, you add back. You get something here. Then you add taxable income omitted. Maybe there are some income that the accountants have included in the income side of the profit or loss account. You know, the income side we include the revenue, other income. In that other income, you may have dividend, rent, interest, royalty, commission, profit from sale of assets, as many as possible. Are we together? So some of those income are exempted from tax, or some of them are not taxable under company income tax. They may be taxed under another tax act. For instance, profit on sale of assets will not be taxed under CIT, it will be taxed under CGT. So you see, if you see all those income that are exempted from tax or not taxable under CIT, you can't allow them to be there. Because if you allow them there, it means they are going to be taxed here. So what do? You less them. But here we're looking at taxable income omitted. So here, under this addition, we're looking at the taxable income, the ones that are taxable, but the accountant did not what? Include them. It could be some revenue of some days. Maybe the revenue accountant have included in income statement. There's some omission. There's some days he did not remember to include. So that's an omission. Okay? Or you can say not reported. So once there is a taxable income that's supposed to be reported but was not reported, then if you have it, you include it. Okay, that's what we're doing here. So the next 2 are deductions. You less non-taxable income. I've explained this earlier. So those income that have been included but are exempted from tax or they are not taxable under these tax acts, you remove them. Like profit or sale of assets. okay, is taxable in a different tax. Dividend also that have suffered withholding tax is exempted from tax. You also remove it, and so on and so forth. So if you have them, you less. Then you also less what? Allowable expenses omitted. So maybe the accountant also did not deduct some expenses, and you know those expenses are allowed. Either he omitted the deductions. So if you have those expenses, you help and deduct. So when you have done this 14, you say the profit have adjusted. This is what I mean by adjusted profit. So this is the profit that is suitable for tax purpose. This is the profit we can tax. So it means that this accounting profit or loss have been adjusted. This is the one we can tax now. So your tax computation will now start here. Okay? Now, so the next thing you have here is your tax computation. How do you do your tax computation? Okay, most of the questions you see them asking you to compute the tax liability. How do you do your tax liability? To start from the adjusted profit. You add balancing charge. Remember I told you about balancing charge. You add it. Then you less loss. Companies claim their loss on carry forward basis. So if they have a standing loss to claim, you less it. Then after loss, you take capital allowance. So loss takes precedence over capital allowance. This profit is known as total profit or taxable profit. This is the profit that can be taxed. Then when you have gotten the profit that can be taxed, then you apply the rate, CIT, at 0% if it's a small company, remember, 20% if it's a medium-sized company, 30% if it's a large-sized company. But remember, you must take cognizance of the year you are computing. Finance Act setting from 2020 tax year. So if it is before 2020 tax year, you don't classify them as such. Okay, you just use 30%. Now, having done this, you also you do education tax. Every Nigeria company must pay EDT. We have 3 rates now for EDT: 2%, 2.5%, and 3%. So you must know when to use them. 2% is before 2022 assessment year. So if you have before 2022 assessment year, remember there is a difference between assessment year and accounting year. So if it is before 2022, we use 2%. 2022 to, let me just say 2023 tax year or assessment year, you use 2.5%. Then after, okay, let's say from 2024 tax year or assessment year, use 3%. So the examiner will always attach this in the last page. So always go to the last page. So that will also help to remind you the rate to be used. So that is for education tax. So this is what you do. You adjust to get the adjusted profit, then you do your tax liability under CIT. Okay? Yes.
So this education tax, do you apply it to the small companies?
Small companies. No, small company will not have accessible profits. Yes. Small companies are exempted from education tax because they don't have accessible profits. Okay? So I expect your questions to be coming in. So if that is all, then we're done with CIT. So we'll quickly review Pioneer. We are left with Pioneer, capital gains, and oil and gas. So let's quickly review Pioneer legislation. Okay. Pioneer legislation. Okay, you know, pioneer is all about incentives that is given to some certain companies, okay? And that incentive is normally 3 years, subject to what? Extension for additional 2 years. That's just what you need to know. Once you understand that, then at least you know.
That's one. When can we, withholding tax we use to reduce tax to the then three is
Withholding tax be used to reduce tax to be paid.
Yeah.
The first one is what?
When do we use 0.25 to calculate minimum tax?
When to use 0.25 to calculate minimum tax.
And then last, TET, unadjusted profit, before balancing charge or after.
Okay, it's TET
It's TET
on.
adjusted profit, before balancing charge or after it. Then I want to add,
Before balancing charge or after. Okay.
then I want to add, under personal, is there a minimum tax under personal income? Is there a minimum tax?
Yes, there's minimum tax. There's minimum tax.
Is it 2%?
1%.
Okay,
1. Okay. Now, these are some of the questions. So let's quickly look at them. The first one is saying, when are we supposed to use 0.25% to calculate minimum tax? Now, you know that, okay, I've erased it. Minimum tax, like I said, is 0.5% of gross turnover minus frank investment income. So that is the standard for Finance Act, 0.5%. But when the Finance Act was introduced, government now felt, okay, let's give some incentives. Since this is the first time we are introducing this new minimum tax calculation, let's give some incentive for 2 tax years. I think that was 2020 and 2021 tax years. So in 2020 and 2021 tax years, they allowed companies to use a reduced minimum tax rate of 0.25%. But after which, we move back to 0.5%. Remember, it's supposed to be 0.5% across. But it's like kind of incentives since it's the first time we're introducing it. So companies are allowed to use a reduced rate. So 0.25% will apply to 2020 and 2021 tax years. While from 2022 will now be 0.5%. That is this. Okay, with withholding tax. How do we use withholding tax to reduce tax to be paid? Using your withholding tax to reduce tax to be paid. Now, what you can use to reduce tax to be paid is what is known as the credit note. Okay? So you can use the credit note. You know, withholding tax is a tax at source. It means that the income you received have suffered withholding tax. The company that made the payments to you have removed the withholding tax. So what you have received is net. Now, on receipt of the net amount, you will be issued what is known as credit notes. And the issuance of credit notes will come from the tax authority. So the tax authority is saying, okay, with your money, I owe you, a kind of I owe you. So they have given you a note showing that they are owing you. So what is expected is the credit note now in future, maybe you want to offset your liability. Let's assume the credit note you have is reading 2020. this credit note of 2020, which is by virtue of the withholding tax deducted from you in 2020, you can use it to offset the tax liability of what? 2020. They won't allow you to use it to offset tax liability of 2021. So the credit notes, by virtue of withholding tax deducted in 2020, you use it to offset tax liability of 2020. That means when you want to pay your tax liability, you just indicate that you want to pay by means of credit notes. You are not going to pay by cash. You are paying using your credit notes. Are we together? So you attach the credit note you are using to make that payment, and it will be offsetted. Another way you can do it is if you don't want to use it to settle your liability, you can also actually come for refund. Okay? And refund, it doesn't mean the year. Okay? You can actually come for refund. So two ways you can use your credit note. One, you can use it to settle liability. You can also use it to claim your tax refund. But if you must use it to settle liability, it must be in the current year. I hope it's clear. So that is how it applies. I think this question has been answered. Now, is TET, that's tertiary education tax, on adjusted profit before balancing charge or after balancing charge? Okay, I know why this person is asking this question. Maybe by virtue of the past questions, Pathfinder, you see some years they will use the one before, and also other years you see them using the one after. But in practice, what is obtainable is that is on assessable profit. So what is the assessable profit? Assessable profit is this adjusted profit, this, before balancing charge. Okay, so always apply it on this, before balancing charge. That is how it's applied in practice. Okay, so always apply it before balancing charge. Don't apply it before the one after. So under CIT, the assessable is the same as the adjusted. Are we together? All right. Any other question?
Is it all withholding tax on rent?
Is it?
Is it all withholding tax on rent?
Is it all?
Yes. That's like, is it withholding tax on rent? Interest, etc. that can be used to settle liability?
Withholding tax on rent?
Yes.
No, now, if it depends. It depends on the transaction. You know, there are different levels of withholding tax. Now, what is the liability you are paying? That's what it depends. Now, we're looking at CIT, company income tax liability. Now, the one you use, look at the income that have gone into this computation. If there are income that have suffered tax, okay, that have gone into this profit or loss accounts, that have suffered tax, then those are what you use to offset the liability. But when you rent, okay, rent can also be part of the income in profit or loss accounts. Depends on the kind of business you are doing. Okay, so if rent have gone into the profit or loss accounts, that means the profit you are paying tax on, the income you are paying tax on is maybe rental income. Then you can use the withholding tax on that rental income also. Everything that have gone into their account, it depends. Whatever you have using, whatever income you have used in preparing that account, if any of them have suffered withholding tax, then you can use it to offset. Do you understand? That's how it works. So normally withholding tax will be on those income, like we say rent, dividend, interest, royalties, and all that. But also you have other transactions that you must maybe contract and all that. So once you have included the income in the income statement, of course you can use the liability either to offset your future liability, your current liability, or you can also come for refund. Okay, if that is what you mean by that question. All right, any other question? Okay. Now let's go to pioneer legislation. Like I said, it's an incentive which is 3 years, subject to extension for additional 2 years. Okay? Now, in pioneer question, you know that it's it is the Nigerian Investment Promotion Council that is in charge of pioneer legislation. So if a company wants to enjoy this tax holiday, you apply to the NIPC, Nigerian Investment Promotion Council. Okay? There is also what is known as pioneer certificates. Once you meet the criteria, the Investment Promotion Council will issue a certificate known as pioneer certificates. And in that pioneer certificate, you will see other things. Among other things, you see what is known as production date. Production date or production day is the day the tax holiday will start counting. Because since they are giving you tax holiday for 3 years, so which year will the tax holiday start, take effect from, the effective date? Okay, so the production day will be stated. Maybe they are saying that the production day will be 1st of June 2018. So what that means is that this 3 years tax holiday you have been given will take effect from what? 1st of June 2018. So your 3 years will start counting from 1st of June 2018. So with your production day, you should know the expiry date of your tax holiday. Because if your tax holiday will begin here, then when is it going to expire? You'll be able to know that. Okay? So in Pioneer, you try to get the Pioneer period. After which you get your post-Pioneer period. That's a summary of what you are doing. You get the Pioneer period in order to know whether there will be profit or net loss. Then after which you get your post-Pioneer period. Okay? Now your Pioneer period is your tax holiday period. Any profit you made in the tax holiday, you are not going to pay tax on it. Now let's look at this question. Look at this. Assuming the production day, which is the effective date, is 1st of June 2018. So it means your Pioneer period will be from 1st of June 2018. That's where it will begin. The first year will end 31st May. That's the first year. So since it started 1st of June 18, which is the production day, the first tax holiday will end 31st of May. That's 12 months. 2019 rather. This is your first tax holiday. Then the second one will begin 1st of June 2019 and end 31st of May 2020. The next will begin 1st of June 2020 and end 31st of May 2021. So this is your Pioneer period. It will begin on the production day and end at the expiry date. Okay, so what are you trying to find out in the Pioneer period? You want to see whether there will be profit or what is known as net loss. So we have to run the basis period here. Let's assume here we have 40 and we have 30 and 50. So when we accumulate it, this becomes 120. So this is the profit, the accumulated profits. Now this profit made during the Pioneer period is exempted from tax because it's made during the tax holiday period. Are we together? That is all for the Pioneer period. But assuming it results to net loss, let's assume this 50 is negative and this 30 is also negative. 40 minus 30 minus 50. That gives you 8 minus 40. So this is what we mean by net loss. So it means that the Pioneer period resulted to net loss. So you net off the profits from the loss. Now it's net. Now it resulted to net loss. What's the implication? The implication is that this net loss suffered in the Pioneer period can be relieved in the first year of the post-Pioneer period. So this once it's net loss or once it's loss, the loss can be relieved in the first year. But once it's profit, just like we did earlier, that profit is exempted from tax. You just ignore it and move to the post-Pioneer period. But once it's lost, you have to take it to the first year of the post-Pioneer period. In the post-Pioneer period, what are you doing in the post-Pioneer period? the business have just commenced for tax purpose. Any profits derived in the post-pioneer period will be subjected to tax. Okay? Remember, in the pioneer period, any profit made is exempted from tax. In the post-pioneer period, any profit made will be subjected to tax. Are we together? So, in the post-pioneer period, which is a new trade, the business have just commenced for tax purpose. That's why you use what? You use commencement rule here. So your commencement rule will be applied in the post-pioneer period. And remember, when we say commencement rule, then it depends. You have the new rule and old rule. So you have to find out whether it's new rule that will apply or not. Now, it means that if it's commencement rule, we need date of commencement. What will be the date of commencement? If the pioneer period expired on 31st of May 2021, so the next day after the date of expiry will be what? The date of commencement. So it means our date of commencement here in the post-pioneer period will be 1st of the next day, 1st of June 2021. That's the date of commencement. So if the date of commencement is 1st of June 2021, which rule are we supposed to use? Is it old or new? Remember I told you, for business that commenced from 2019, use new rule. Obviously, 2021 is from 2019, so new rule. So we are using new rule here, and if it is new rule, tax years, basis period, assessable profit. What profit we tax in the first year of the new rule? We say profit from the date of commencement, 1st of June 21, till end of the first accounting period of the business. Now let's assume their year end is December, or let's say their year end is October, so till 31st October of 2021. And the tax year for the new rule is on preceding year basis, so here will be 2022. Do you remember? Okay, so the second year we follow from the next day and so on. But assuming this date was, let's say, 2018, then obviously you should know that the next day will be 1st of June 2018. Then it should be new rule, or old rule rather. If it's old rule, remember two computation, normal and revised. You choose one. So the same thing we did on basis period, we also apply anywhere you are going to do basis period. The same thing we apply here. Okay? So the net loss from the pioneer period will be relieved in the first year. So in this profit is where we are going to relieve this loss. Are we together? After we have relieved this loss, any other balance left is lapsed, cannot be relieved again. That's the nature of pioneer. You only relieve the net loss from pioneer period in the first year of the post-pioneer, after which you can relieve it further. So that is just it about pioneer question. So pioneer question will be a full question, like you need the knowledge of your basis period. As you can see, you need to apply commencement rule here, and you need basis period to get this profit. So you need the knowledge of basis period. You also need capital allowance, because at the end they will say compute tax liability. And remember, whenever they say compute tax liability, this is what they mean. Start from the adjusted profit, add balancing charge, less loss, less capital allowance. So you also need capital allowance. So at times they will give you assets to compute. So you need the knowledge of how to compute capital allowance. Then you need tax liability. You need the knowledge of how to do tax liability. That's this and this. Because at times they may give you accounting profits that you need to adjust. You also first adjust before you go on. So these are the three things you need to do pioneer. Okay? All right. So that is it about pioneer legislation. I expect your questions also to be coming in with regards to pioneer legislation. So we have two more. Let's quickly take capital gains tax. Okay, capital gain starts. CGT. Of course, you know this has to with against us, which is 10% on the capital gain. Now, how do we compute capital gain? Just simple calculation. You say sales proceed of the assets less cost of acquisition. So the sales proceed minus the cost of acquisition. That's what gives you either capital gain or capital loss if negative. So the CGT at 10%. So CGT is always at 10%. You have something or you have nil if it is loss. That is all. So it's a very simple computation. You compare your sales proceed and the cost of acquisition. That will result to capital gain or capital loss. Then CGT at 10%. So for instance, if I have sales proceed of 100 and my cost is 70, it means I have made a gain of 30. I'll pay the CGT of 3. That's just what it means. If my sales proceed is 100 and my cost is 120, it means I've made a loss of 20. This is what I mean by capital loss. So there will be no CGT on capital loss. It will be nil. Okay? Now, if it results to gain, you pay CGT. If it is result to loss, you are not paying CGT. Rather, you have a relief. Relief. So for this capital loss, you get a relief. So now there is relief on capital loss. But how do you relieve this? Let's assume this asset is plant and machinery. So, and this loss resulted in 2022. I disposed plant and machinery in 2022 and I got this loss of 20. Whenever in future I dispose another plant and machinery, let's say sales proceed 80, cost 30, gain of 50. Now I have disposed another plant and machinery, but this time around resulting into gain. I will be allowed to offset the loss from the gain. That's how I can claim my relief. So the relief or loss does not mean you will be giving money back. No. Okay? You can only get the relief when you dispose the same asset in future, the same class of asset in future. Okay, now is it a machinery? Which asset I disposed that resulted to loss? I'm allowed to take the loss. I will say less loss. Brought forward 20. Okay? So I will be taxed. This is now my net capital gain. I will be taxed on 30. So my CGT now will be on 30. That's 3. But remember, if not for this loss, I would have been taxed on 50. It would have been 5. Are we following? So you can only be allowed to offset your loss when you dispose assets in the same class with the assets that you suffer the loss in future. So assuming this asset is this new asset I dispose in motor vehicle, I can't offset this loss from plant and machinery from the gain of motor vehicle. No, it must be the same asset. Okay?
Do you have a certain period that lasts before you can?
Before you can. No, the finance act did not say. It's just like losses can be relieved indefinitely. It doesn't matter, yes. There's no certain year that you have to stop. It's indefinite. You keep carrying it forward, waiting for whenever you are going to dispose that asset in future. So that is the implication. That's how you do capital gain or loss. Okay. Now, you know also other issues with regard to CGT. You know issues regarding to partial disposal when you dispose part of an asset. So for partial disposal, we say you need to get the cost of part disposed. That's the main thing there. Using the formula A over A plus B times C. Okay? And we say that if it is partial disposal, then you must use this formula. If you are not going to use this formula to get the cost of the part disposed, then it's not partial disposal. If it is partial disposal question, you must use the formula to get the cost of the part disposed. Okay? Take note of that. So at times, the question may look like partial disposal, but actually it's not partial disposal. Once the cost of the part disposed is known, once the examiner have given you the cost, then it means the examiner is not expecting you to use this formula. So if that is the case, it's not partial disposal, irrespective of how the question look like partial disposal. Okay, so that is just it, when you dispose part of an asset. Also, remember the issue of connected persons. Connected persons. Those that are closely related. Those that are closely related with each other. A company is related to its directors, its managers, and so on and so forth. Okay, so transaction between a company and its director is a connected person transaction. Okay, so you already know those transactions that are connected person. Now, how do we compute CGT on connected persons? We just compare, we pick the higher. We say higher of 1, we compare the actual sales proceed. And the market value. So we want to just see whether the transaction was done at arm's length or not. So we compare the sales proceeds, the amount realized from selling that asset, and what the market value should be. We pick the higher of the two, then we less cost of acquisition. So the higher will less cost of acquisition. That will give us our capital gain. Then CGT at 10%. So you pick the higher of these two. So the examiner will give you the sales proceeds and also give you what the market value of the asset is. Okay? So normally you will be told the nature of the transaction. They will say a company sold to its directors. So once you see that, you should know that it's a connected person. A company sold to its manager. A parent sold to his subsidiary. Okay? A partner sold to his co-partner. Okay? A husband sold to his wife. Well, those are connected persons. They can influence the transactions. That's the thing. So once you see it, compare the actual sales proceed on which the transaction was done and the market value which will be given to you. Compare it. Just pick the higher. The higher will be the sales proceed that will be used. Then less cost from it, then your tax. That is how you do it. Okay? There are other areas like rollover relief. You know how to compute rollover relief. Of course, you also know issue of installment, CGT by installment, that we say that the CGT will be paid by installments, provided installment period is not less than what? 18 months. So all this, and also the hire purchase issue and all that. So once you put marks, 15 marks, as the case may be. So take note of this. So we are left with, if there's any question, please, I expect your questions to be in by now on CGT or what we have done so far. So we are taking the last one now, which is oil and gas taxation. Oil and gas taxation. Okay. Of course, you know, when we say oil and gas taxation, the new act is now Petroleum Industry Act. PIA. Okay, before now we use Petroleum Profit Tax Act. So we don't expect the examiner to set the old one, PPTA, because that would be asking too much from, because PPTA is a very wide syllabus, and also PIA is also another wide syllabus. So the two of them, so that is why all this why the examiner have concentrated on certain Petroleum Industry Act. And when you say Petroleum Industry Act, it's all about hydrocarbon tax, remember? Okay? Now, you know that we have the upstream companies. We also have the midstream and the downstream. That's a classification by the Petroleum Industry Act. Now, you know, upstream are those ones that are into what? Oil and gas exploration, prospecting, mining, and so on. All those ones that produce crude oil or natural gas, they are upstream companies. So PIA is all about upstream companies. While the midstream are like refinery operations, or if you own a refinery, you are in the midstream. Okay, if you have, let's say, pipelines through which oil and gas are transported, that's also midstream. Some also have terminals, exports, import terminals, all those are midstream activity. Now, downstream activity is more of selling the products, petroleum products, like filling stations, oil marketing, transportation of petroleum products. All those tankers that transport PMS, DPK, and all that. Those are downstream activities. So when you read a question, you should know whether the examiner is talking about upstream, midstream, or what? Downstream. Okay. Now, if it is upstream, upstream are supposed to pay two tax. Remember, they are paying hydrocarbon tax and CIT. While midstream are paying only one, CIT, downstream CIT. Okay? So you see that CIT is just a new thing added to oil and gas, because it's supposed to be under Company Income Tax Act. So this CIT is covered by Company Income Tax Act, while the hydrocarbon tax is what is covered by Petroleum Industry Act. So that's why I say Petroleum Industry Act is all about hydrocarbon tax, while the CIT aspect will be gotten from Company Income Tax Act. Are we together? So the new thing here is hydrocarbon tax. How do you compute hydrocarbon tax? Because it's believed that you already know how to compute company income tax by virtue of what? Company Income Tax Act. Hydrocarbon tax. So what are the income you need for the computation of hydrocarbon tax? You need the income from crude oil. So if you are doing your hydrocarbon tax, which is for upstream companies alone, remember, upstream companies are the only ones that are subject to hydrocarbon tax. Midstream and downstream will not pay. Okay? And of course, in upstream company, there are two that are also exempted from hydrocarbon tax. What are those two? The two that are exempted are those ones operating in the deep offshore, and those ones that are operating in the frontier basins that are yet to be reclassified. Okay? Those are the two upstream companies exempted. Every other upstream companies will pay hydrocarbon tax. So you need to read your question very well. Examiner will explain all this. Okay? You need to understand whether it's an upstream company. If it's an upstream, is he exempted? Is he operating in the deep offshore? If he's operating in the deep offshore, then don't do HT, do CIT. If he's operating in the frontier basin, don't do HT, do CIT, and so on and so forth. Okay. So what are the income you need for hydrocarbon tax? You need crude oil. You know your income from crude oil. How do you value it? You say the number of barrels produced per annum, not per day. Some question they will give you the number of barrels per day, per month, per week. Please always convert per year. The number of barrels per annum multiply with what? Fiscal oil price. This fiscal oil price is determined by the commission. The commission is the agency of government in charge of the upstream. They are the ones to determine what the fiscal oil price is. So the number of barrels produced per year times what the fiscal oil price they will give you in the question is. That will give you the value of crude oil sold. If the fiscal oil price is in dollar, normally it's to be in dollar, and they want you to do the computation in naira, they will give you exchange rate. So if you are given exchange rate, multiply with the exchange rate to get the naira equivalent. But if you are given in naira, or they want you to solve in dollar, then they will not give you, they won't give you exchange rate. So this is how you value the crude oil. So once you get the value of crude oil, the next income that will come for hydrocarbon tax is condensates. Remember condensates from associated gas. Remember, we have condensate from associated gas. We have also the one from non-associated gas. The one you bring here is the one from associated gas. We have explained all that. You remember? Okay. How do you value it? The same way. The number of barrels times physical oil price, which will be given, times exchange rate, if they want you to solve maybe Naira or so. So the same way you value crude oil is how you value condensate, because it's also in liquid form. It's measured in barrels. So you get the value. Then the next one is natural gas liquid. From where? From associated gas. So also the natural gas from liquid. So you see, this one is in liquid state. It's not the natural gas itself. It's a liquid from the natural gas. That's what you bring here. The natural gas itself, which is in gaseous state, is taxed under CIT. Okay? It's not taxed under HT. So it's only the liquid that is taxed here. That's what you are bringing here. How do you value it? It's also in liquid. Then it's also measured in barrels. So it's also the same valuation. Number of barrels times the price, exchange rates. You get the value. Another income that we come in here is balancing charge. That's the fourth income. So these are the fourth income you need for hydrocarbon tax. So you put your balancing charge here. Now, these three, don't add the four at once, just add the first three to get something here. This three is what is known as gross revenue. Remember what you need gross revenue for. Use it for CPR limits. So these three, crude oil, condensate, and natural gas liquid, will give you the gross revenue. Then when you got your gross revenue, you add the balancing charge to get your maybe total income. So this is what will be on the income side, 4 income, 4. Remember, it's not compulsory that you'll be given the 4 in the question. They may choose to give you only crude oil. They may give you the 3, they may not give you balance. So, but these are, at most, these are the 4 that are supposed to be here. So when you have income, many income in the income statement, these are the only 4 you need for HT. Other ones goes to CIT. Okay, take note of that. That's the income side. Then the expenses side of HT, you list those section 263 allowable expenses. Remember them. All those expenses that are allowed for hydrocarbon tax. All royalties incurred and paid. Rent, that's concession rentals, contribution to host community, contribution to environmental remediation, contribution to NDDC, repairs of production equipment, and so on and so forth. Stamp duties, levies to government, okay? Abandonment and decommissioning fund contribution, and so on and so forth. So you add them up. But you must subject them to what is known as what? CPR limit. Okay? We said those allowable expenses must not exceed the CPR limit. So the allowable expenses to be deducted in any tax year should not be more than what? The CPR limit. The CPR means cost price ratio limit. So when you total those allowable expenses, you compare them with the CPR limit. How do you get CPR limit? CPR is the gross revenue. CPR limit. Remember, it is 65% of the gross revenue. 65% of this. That's the CPR limit. So you compare the allowable expense. Just the same concept with capital allowance restriction. The same way you do capital allowance restriction. That's the same concept with this CPR limit. Are we together? So when you subject to CPR limit, what do you do next? You less. When you subject to CPR limit, you can now talk of other allowances like balancing charge. I say balancing charge like capital allowance, production allowance before you tax. But you know that there are 2 rates for hydrocarbon tax. If you can remember, we have 30% and 15%. So you must also know when to use 30% for HT calculation. We say for 30%, if it is petroleum mining lease, if it is petroleum prospecting, oil prospecting license converted to PML, if it is OML converted to PML, if it is frontier basins reclassified as PML, that is when you use 30%. So every other one use 15% for hydrocarbon tax. Are we together? So I don't know, is there any question on oil and gas? Is there any question on generally?
Okay.
Yes.
We have questions, but not on training.
Okay. So let's take general questions, then we can call it a day. On advanced taxation. Yes. Okay.
I think most of the questions are actually on capital
Allowance, okay.
Can you explain how capital allowances can be carried back 5 years?
Can we carry back 5 years? Okay. Explain how capital allowance can be carried backwards for 5 years. Okay, 2.
Second one is, how do we determine the year of assessment of CGT? Because when it is paid via
Via
higher
year of assessment
for CGT,
for CGT
via higher
on hire purchase. Okay. All right. The first one says explain how capital allowance can be carried backward for 5 years. Of course, you know, when you talk of carrying capital allowance backward, it has to do with terminal capital allowance. Capital allowance remaining on claim as at the date of cessation. That means the business have ceased operation today, but the business have some outstanding capital allowance to claim. Those are what we mean by terminal. And we say that there is room for business to also claim, but how? There is no forward again because the business have ceased. But they can claim it backwards for maximum of 5 years. And where are they claiming it from? They are to claim it from their total profit. Are we together? They are to claim it from their total profit. So is in your tax liability, look at this. Let's assume this is 2020 year of assessment. You have assessable profit of 100. Then let's assume you also have capital allowance. You relieved 30. So 70 is left. This is your total profit. Then you pay tax at, let's assume 30%, which is 21. Of course, you paid EDT too, but let's leave EDT. So this is your tax computation in 2020. And also in 2021, your assessable profit is 40. Then capital allowance. You cannot claim 70 for 40. So how much can we relieve? You relieve 40 because that's what you can take. 30 is unrelieved. Unrelieved capital allowance carry forward. So your total profit this time around is nil. Your CIT at 30% will be nil. Okay? Now, let me put one more. Or let me add 2019. Assessable profit. $80 less capital allowance. Let's assume it's 70. So this 10 total profit. CIT at 30. 0.3. Okay. So let's assume you have done these computations for the relevant years. 2019 of assessment, 2020, these are your tax liabilities. I've shown you how to do tax liability earlier. Now, this is a cessation question. This is the last year of cessation. Okay? This is the year of cessation. That means no forward again. The business have ceased this year. But what do you think happened here? You see that there is an outstanding capital allowance of 30, which is supposed to carry forward to 2022, assuming the business is still a going concern. But now it has ceased. So it means you can't carry this forward again. But we say that this is what we mean by terminal, because it happened, it's right there at the date of cessation. But what the business can still claim it, but how? Backward. They can take it backward for maximum of 5 years. And they should take it from where? Their total profit. So if that is the case, then how do you apply that?
Backwards, you need consecutive
Yes, consecutively. Yes. So let's see how to do that. Okay, it means that we are going to start. Which year are we going to start to carry backward this capital allowance? The law says start from the penultimate year. Don't start from the year of cessation. Start from the year before the year of cessation. So this is the year of cessation. Obviously, this should be the penultimate. So I will start carrying backward from the penultimate. That's from 2020. So I will say 2020 year of assessment. That's the penultimate year. Where am I going to relieve it? From which profit? The law says relieve it from total profit, because the tax you paid is from total profit. So the relief will be given to you based on the tax you paid. So you take it from total profit of that year. So I will start with total profit. So what is the total profit of 2020? That is 70. So I will now less capital allowance carried backward, right? What's the capital allowance brought backward? 30. I will relieve it. 30. Obviously, you can see that this 70 alone can take care of this 30. So it means I can relieve it directly. So I still have profit of 40. So it means that I was able to relieve all the capital allowance just in the first year. Okay? But assuming this was, let's say, 300. So it means that I can't relieve 300 from 70. So the only thing I can take here will be 300. Will be, what's it called? 70. So this is the capital allowance. Assuming it's 300. So how much can I relieve backward? I can only relieve 70. So it means I will have a standing of 230. So my total profit will be nil. Then I will be refunded. Tax refund. Because the implication of carrying it backward means that any tax you must have paid will be refunded. So what's the tax refund? It will be the tax rate used in that year. That's 30% of the amount of relief I was given now. 70. So 30% of 70, 21. That means out of the, okay, you see, that means the whole tax I paid here will be refunded to me back. That's the refund. So when you carry backward, always calculate the refund for that year before you move to the next year. So I have outstanding 230 to be carried backward. And it's remaining how many years now? 4 years. So I move to the next year, which will be 2019. In 2019, the total profit is it 10? 10, yes. So what can I relieve here? Less capital allowance. I have 230. I can only leave what? 10. So the amount is 230, but the relief will be 10. So it means I will have 220 left. So I will take 10 here. My total will be nil. That means all tax I have paid in this year should be refunded back to me. So what is my refund? Will be the tax rate used times the relief, 10. So 0.3, which is what I paid there, will be refunded. So I still have outstanding 220. And I still have 3 years more. So assuming I have information for 2018, I will do the same thing. That's how we do it till I relieve all. But once I get, after the 5th year backward, if I still have any outstanding, that one is what? Terminal and what? Lost. I can't carry it beyond 5 years. That's what it means. So that's just how you apply that.
And how do you determine the year of assessment on that year of cessation?
The year of assessment on the year of cessation. It depends on the rule you are using. Depends on whether it's old or new. Okay? If it is the new one, we say the profit you tax is the profit from the beginning of the accounting year or the accounting period to the date of cessation. So if a business ceases today, if it's a cessation question, they will give you the date the business ceases. What's the profit that will be taxed in the year of cessation? Is the profit from the beginning of the accounting period to the date of cessation. It could be 1 month profit, it could be 2 months, it could be 3 months, it could be 12 months. So that's what that means. Yes, it may be prorated. Okay? Now, what will now be the tax year? I think that's the question with the new rule. Let me use this to explain that. If this is XYZ Limited, and the year of cessation, this is a cessation. The 30th September 2023. So this XYZ sees 30th September 2023. And the accounting period or accounting year end of this business is, let's use October, or let's use May, 30th May of every year. That means the business keeps its record to May. So these are the 2 dates you need to do cessation. So in the year of cessation, which is where the question is coming from, which profit will be taxed? The profit that will be taxed is the profit from the beginning of the accounting period to the date of cessation. The date of cessation here is 30th September 2023. Beginning of the accounting period to the date of cessation. So what's the beginning of the accounting period? The examiner will not give you the beginning of the accounting period. The examiner will always give you the year end. It is believed that once you are given the year end, you should know what the beginning should be. Yes. So if the year end given is May, then the beginning should be June. Or June to May is 12 months. If the year end is December, then the beginning should be January. Okay? So now the year end is May. It means the beginning will be June, 1st of June. The beginning of the accounting period, because the year end is May, the beginning should be June, to the date of cessation. So which of the June is closer to this? It should be June of 2023. Okay? How many months profit is this? This is June to September. Is it 4 months? 4 months profit. That's how you get the basis period. Now the question says, how do you get the tax year? The tax year, if it's a company, count 6 months. 6 months from date of cessation. So count 6 months from the date the business is. The business is 30th September 2023. 6 months will be when? 6 months will be March. Is it March of next year? It will be March of next year. Yes. Because this is 30th September. So yes. Yes. So we are counting this 30th September. So we count October, November, December to March. So it will be March of 2024. 6 months from 30th September 2023, which is the date of cessation, will be March. 31st March of 2024. Yes. So this 2024 becomes the tax year. So when you count 6 months, any year it falls, that's the tax year you use in the year of cessation. Okay? Once you count 6 months, any year it falls, that will be your tax year in the year of cessation. That's how you determine it. I think that's the question. Okay. Now, assuming this date of cessation is, let's say, April. When you count 6 months, it will fall what? October. It will be October. Yes, October of 2023. So the tax year here will be 2023, not 2024. So once you count the 6 months, well, any year it falls for companies, that is the tax year.
What will happen to the beginning of the year, in June?
The beginning will still be certain because the year end is May. Okay? Remember, this beginning depends on what the year end is. Yes.
But the year of transition is before. I don't know if you understand that.
Okay, this one now. You know, I just changed it now. I just changed it.
Does it change the analysis of the disparity?
Of course, it will change. I'm supposed to have changed this so that it will be in line. But you know, I used September before. I just use this to clarify the 6 months.
But assuming this is the case, how do you treat this?
Assuming this is the case, then this cannot be 23. This will be 22. As I said, the closest one. This will be 22, as I told you. All right. So I think, is that the question? Okay. The second one says, how do you determine the year of assessment for CGT on hire purchase? CGT on hire purchase. Also check when it has to do with hire purchase. You know, CGT is normally on actual, generally, CGT is on actual year basis. CGT is on actual year basis. And now we also have what we mean by due date. Okay, for CGT. But once it's on hire purchase transaction, you do the computation. So you will not quickly go and write. You will not quickly write the tax year because you may not know the tax year. Unless in the question you'll be given the date of disposal. I think in the question you'll be given the date of disposal. So once you are given the date of disposal, let's say the date of disposal is 30th September 2022. Let's assume we are given that the date of disposal of this for this asset. Remember, we're looking at hire purchase. Hire purchase is different from installment. I hope you are not trying to. It's different from installment. So here in hire purchase, what we are just looking at is the interest. That interest that is in the hire purchase price, which we said is not allowed. Okay, we need to remove it. That's just what makes the difference. But remember, in the computation, you compare the sales proceed, which will be given to you, and the cost. And the cost is the hire purchase cost, which is what? The initial deposit and the installments. Okay, so what determines the tax year here is the year of disposal. Okay, when was it disposed? Then you trace. It's different from installment question. In installment question, we'll start looking at when the payments were made. We'll say if the first installment come in maybe in 2020, it will be the tax year for the first installment. The next one will come in 2021, it will be the next. But this is not installment. In hire purchase, the main thing we are looking at here is the interest element, which is not allowed. So if you are given the date of disposal of assets, CGT on hire purchase, then that date of disposal will be the what? The tax year. But of course, nowadays, you take cognizance of what? The due date. Remember, we have two due dates. We have June due date or September due date. For this asset that is disposed on 30th September 2022, which due date will it fall? It will fall in December due date. Okay? So it will fall in December due date. But it's on actual year basis. So the tax year will also be what? 2022. But if it is hire purchase you are now looking at, if it is installments, transactions you are looking at, the examiner will give you the number of installments or how the payments were made. So the tax year will be in accordance to how the installments were also made. So in that regard, you will not have one tax year. The tax year will be based on the installments. But hire purchase, the key thing here is just that interest element, just to remove it and you do your CGT. So if you are given the date of disposal, that will be the tax year. Okay? So any other question? Okay.
Can you just give us the likely places we have this country?
Likely. The examiner set questions from, in fact, all the topics are, these are the key topics. That's why I'm revising them. But you know that some topics are very key. You see them in the exam. Like this capital gains tax. Almost every diet you see it. Oil and gas, now always every diet you see it. But these topics, of course, you don't expect these two as a full question. So your questions, you are looking at this. No examiner will give you basis period as a full question or capital allowance. These are workings to this. So examiner will just give you company taxation. Because under company taxation, he knows that you are going to do basis period, you are going to do capital allowance. He may also give you pioneer. Under pioneer, you also do basis period, capital allowance. Okay? So the way it works is that these two topics, they are almost testing the same thing. Because these two are testing basis period, capital allowance, and tax liability. So they are testing the same thing. That's why you see in some diets, you see whenever the examiner brings company income tax, they will not bring pioneer. Whenever they bring pioneer, they will not bring CIT because they are testing the same thing. So the ones that you always see on the diets that are on their own separate, they are testing different things, is these two. That's why you see them every diet coming. So these two must always come. But these ones, these two, they do alternate them. So last diet, I don't think there was pioneer legislation. So it's likely you have it this diet. They alternate it and all that. Another topic, they also, like double tax. You see double tax is testing the same principle. Basis period, tax liability, capital allowance. So those are the three they alternate. Okay? So they can set pioneer and double tax. Or they set CIT or double tax and double tax. So it depends. But these are the key topics. These are the key topics. So there are other topics, but these are the main ones. Okay, so if you know this very well, your company tax, pioneer, capital gains tax, oil and gas, then there's no how you'll not be able to get more than 50. Okay, so that's just it. Any other question? Okay.
What is the difference between hire purchase and installment?
Difference between
Hire purchase and installment.
the transactions, although they look similar, but they are not, in CGT, they are not looking at the same thing. Difference between hire purchase and installments. Okay, now let me start with installments. In installments, we are just looking at whether the taxpayer will be allowed to pay his CGT by installment. That's just the thing. Yes, because this taxpayer disposed his assets and he didn't receive the full sum. The agreement is that the buyer will pay in installments. Okay, so the seller will not receive the full payment at once in one lump sum. The payment will come in bits. Okay, so the question is here is that since the payment is not going to come at once, it doesn't make sense for you to ask the taxpayer to pay the CGT at once, because maybe the payment may come in 3 years' time, but every year a payment will drop. It will be made 3 times. Maybe every year payment will drop. So if you ask the taxpayer to pay the whole CGT, he may not have the money to pay it. So the argument here is that would the taxpayer be allowed also to pay his CGT by installments? So that means if I receive the first installment payment, I will pay the CGT portion of it. I receive the second installment, I will pay the CGT portion of it, just like that, so that it will not be much on the taxpayer. That's just the argument under installments. Will he be allowed to pay by installments or not? And we say that the taxpayer will be allowed to pay by installments, but provided that the installment period is not less than 18 months. That's it. 18 months. Okay. But in hire purchase, the argument is not whether it is going to pay by installments or not. The argument in hire purchase is hire purchase price is always the initial deposit plus the installment. The installment is always interest. That's why higher purchase price is always more than the cash price. If you are buying and paying cash, higher. Why is higher purchase price higher? There is interest, because you are tying down the money. The owner have charged you interest. That's why higher purchase price is higher. And we say that interest is not allowed in CGT, because in CGT we said any expenses that is allowed in CIT, PIT, PPT, or PIA will not be allowed in CGT. So interest will be allowed in CIT. It can't be allowed here again. So the argument here is that that interest in the higher purchase price is not allowed in CGT. So we need to remove it. Okay? So this higher purchase CGT is looking at removing the interest element in the higher purchase price. While the installment part of CGT is looking at, are you going to allow me to also pay my CGT by installments? That's just the difference between the two under capital gains tax. But although the nature of the transaction may look similar, but in CGT, those are the differences between the two. Okay, any other question? Okay. In the absence of any question, and of course, we want also use this opportunity to wish you well during your exam. We pray that at least, having done your best, God will crown your efforts with success. You will all come out in flying colors. Okay? You have testimonies. Thank you very much for paying attention and for your questions. I appreciate you all. Thank you.